Welcome to The Wealthy and Wise, where we answer your questions regarding protecting and growing your wealth.
Laura, what is going on with the world today? We have unrest in the Middle East. We have natural disasters happening everywhere. We have people fearful because the gas prices are going up all the time. Should people be in the markets right now?
Well, okay, you're asking two questions really, Deidre, because the truth is there is a lot going on in the world, and we need to be cognizant of that. But when you talk about investments, we're talking about risk in general and whether people should be taking on that risk. And truthfully, investing is a balance between risk and reward. Risk being that you have the potential of losing some of your money, all of your money, or even maybe more than the money that you invested if you're using leverage. Return being the reward that you'll get if you take on the risk. So there is a lot of risk out there in terms of investing.
People are still very scared about 2-3 years ago. They've seen what's happened with their portfolios. They see what's going on in the news. How do you make some intelligent decisions about what you should be doing if risk is out there?
Yeah, risks vary. So you need to understand the different kinds of risks. There's risks associated with the asset classes. And when I talk about asset classes, I'm talking about large cap versus small cap versus international versus commodities. There's risks associated with securities. When we're talking about securities, we're talking about stocks, bonds, mutual funds, ETFs, things that would represent different asset classes. There's risks associated with the issuers. So New York City is an issuer, the US government is an issuer, Exxon is an issuer, Apple is an issuer. So there's risk associated there. And then there's the macro risk, which is what you're kind of alluding to, which is the economic climate. Where are we in the business cycle? Where are we in our political situations with unrest and so forth? What is the monetary policy of this country versus another country, which impact currency issues, which impact inflation, interest rate issues? So there's quite a lot out there, and the risks go broad and they go deep, and you need to understand them.
Okay, so if there's a lot of risk that's out there and there's things that we need to be thinking about, how can a person looking at their own portfolio, even on a macro level, look at, is there a way to categorize risk so I can determine, is this something that I'm willing to take on, or is this something that, whether it's because of what's going on in the world today or whether it's because of how I'm invested right now, that I maybe need to be doing some shifting? What are some tools that somebody could use in looking at risk?
So the finance books generally categorize risks into pretty much two broad categories, but I'd like to bring it down into kind of how I look at risks. I really look at risks in four different areas in terms of the risks that we can actually work with and control. One type of risk is really avoidable risk. Okay, when you say avoidable risk, they're risks that you really don't need to take on, so why would you go there? So quality, investing in things that don't have quality is a risk that really is not necessary. I don't think that most people should be putting a lot of money into things like junk bonds or issuers, companies that issue junk bonds. Maybe you might want to invest on the equity side. Well, if they're issuing out junk bonds, that company is distressed in some fashion, and you don't necessarily, if you don't understand why it's distressed and whether it has the potential of coming back, you shouldn't invest in it. The other component of avoidable is putting too much money into one individual company. When you put a lot of money in one individual company, you are in fact investing in that management team. Do they have a good relationship with their board? You're investing in their product pipeline. Do they have any litigation? All of those things inherent with that individual company. Now, if you really want to make a company bet, I would say go for at least the sector and bet on a sector, so a bunch of companies within that individual industry. But ideally, you want to get a lot of the different sectors, and the term for that is diversification. A lot of you have heard about diversification, and really all it means is putting all your eggs in different baskets so that you have a lot of exposure around in many places.
So if we have avoidable risk is something that we're able to possibly easily avoid. And so you can look at your investment portfolio with reference to that. What are 3 other types of risks that people should be aware of?
A second risk that I often talk to people about is market volatility risk. And when you talk about market, I'm not just talking about the S&P 500 or the Dow Jones. I'm talking about all the different markets, international markets, small cap markets, all the different markets have volatility risk. Each asset class has a different pattern of behavior. They're all cyclical in nature. And when you study the cycles, you start realizing that not all of them are down at the same time. So what you want to do is you want to pair up asset classes that are doing well during one period of time with asset classes that aren't doing as well at another time, and then vice versa. The technical component vernacular is that these asset classes are negatively correlated. But it really does work because what you're doing is by pairing these asset classes together, you're smoothing out the volatility in the market. And volatility is a bad thing. It does take money away from your portfolio. So you want to do that.
So we have avoidable risk. We have risk that can be mitigated, maybe through some asset allocation. What are the other two types of risk that you see in the overall sense?
Well, a lot of folks are scared right now. A lot of things have happened. So they've said, I'm not going to take any more risk. I'm going to take my money and I'm going to put it under the mattress. Well, guess what? You're taking on risk by putting your money under the mattress. Or somebody might say, I'm putting money into a CD that pays no interest rate. So it's like putting your money under the mattress. The problem with that is an issue called purchasing power risk. And it has to do with inflation. We know that we have historically had inflation of 3%. We may even have inflation that runs a little higher over the next 10, 20 years. So if you are currently spending $50,000 to live a certain lifestyle right now, in 20 years, you're going to need $100,000 to live that exact same lifestyle. So that money that you put under the mattress is now not worth the same amount of money it was worth today.
Okay. So putting it under the mattress, not a good investment plan, it sounds like.
No.
So what's the last area of risk then, if you're going to do in the broad categories?
Well, this is actually, I call it a hidden risk because many people are unaware of this risk, and it has to do with our human nature. It is behavioral risk, where most of us do react to fear that we're going to lose our money, and greed when things are going well. We want more of it. Well, those emotions that we have really are very bad emotions or bad triggers to get us to make decisions in investing. We need to take those emotions out of investing. Every situation that I've seen where people have used their emotions, they have made the worst decisions. And the studies are out there. And someday we even maybe should talk about some of these studies because they're out there and they demonstrate how badly people destroy their investments when they use their emotions to make decisions.
Well, I see that a lot in my practice also. It's not just emotions in making decisions in investing, but it's emotions in making decisions about how am I going to be able to get to my goals. I think what I've learned here today is risk is a bit of a four-letter word. There's a lot out there that I have to say I was unaware of from my perspective, and to follow up what you're saying, maybe we can do some podcasts on these individual areas of risk and also talk about some of the things that you seem to indicate could mitigate them, like diversification and asset allocation. But just as we're closing up here today, what can an individual do to evaluate the kind of risk that they have right now? What are there any concrete steps that somebody can be taking today?
Well, you have to be realistic with yourself. You have to understand what risk you are capable of taking on in terms of tolerance. When you're investing in something, you don't want to be staying up all at night. You want to make sure that you are comfortable with it and that you in fact can afford the potential of losing that money if you invested in it. But very, very important, and something that I'd like to talk about also in a future point, is having a strategy. Setting up a strategy before you even make any decisions on what you're going to invest in, when you're going to invest in it, when you're going to buy, when you're going to sell, under what conditions, without emotion. And then when something happens, hopefully you're not reacting based upon emotion, you're reacting based upon your strategy.
Well, one of the things that we talk about here at The Wealthy and Wise is that we want your questions so that we can be able to answer them here. So maybe you have a question about what kind of strategy might make sense for your situation. And if you could send us an email to questions@thewealthyandwise.com, we'd really look forward to being able to address those either in a future episode like this or in a future podcast, or to be able to find a way to make sure that you, the middle class millionaire, are getting the information that you need. Thank you for watching, and we look forward to seeing you next time.